Warren Buffett, widely regarded as the most exceptional investor in history, commands immense attention each year following his annual Berkshire Hathaway conference. The scrutiny is so intense that every statement he makes during the event is meticulously analyzed. This year, the primary focus was on Berkshire's staggering cash reserves and the potential implications for the overall economy. Many observers believe that Buffett's cautious approach to investing his vast cash holdings is a sign that he anticipates a significant economic downturn in the United States and is preparing for it. This perception is reinforced by the notion that when a seasoned investor like Buffett is reluctant to invest their cash reserves, it may indicate that they do not see sufficient value in the market. For instance, Buffett's Berkshire Hathaway has been holding a record amount of cash, exceeding $189 billion. This substantial cash pile has sparked speculation about Buffett's market outlook and his strategy for navigating potential economic challenges. Some experts interpret this cash buildup as a sign of Buffett's bearish sentiment, suggesting that he's bracing for a market correction or even a recession. This interpretation is supported by Buffett's historical behavior, as he's often used his cash reserves to make strategic investments during times of market volatility. Buffett's investment philosophy, which emphasizes value investing and a long-term perspective, has been highly successful over the years. His ability to identify undervalued companies and make timely investments has generated impressive returns for Berkshire Hathaway's shareholders. However, his current cash holdings have raised questions about his market expectations and whether he's anticipating a significant economic shift. While Buffett has not explicitly stated that he expects a massive economic crash, his actions and statements have contributed to the speculation. With Berkshire Hathaway's cash reserves swelling to a staggering $189 billion, there's widespread speculation regarding Warren Buffett's perspective on the overall market, with many questioning if he views it as an inflated bubble. The sheer size of the S&P 500 listed companies presents a challenge in identifying suitable investment opportunities, prompting concerns among observers. A visual representation in the form of a chart vividly portrays the unprecedented scale of Berkshire's financial arsenal. One commonly proposed rationale for this substantial growth is the appeal of current cash yields. It is crucial to understand that when Warren Buffett refers to his $189 billion cash position, it comprises cash equivalents primarily in the form of short-term U.S. Treasuries. While this distinction may seem complex, the essence lies in these holdings generating a yield. The current 3-month U.S. Treasury yield stands at around 5.4%, making them an exceptionally attractive and secure investment option. Despite this, Buffett clarified any misconceptions during the recent conference, emphasizing that even if the yield were as low as 1%, he would uphold the same level of cash reserves. This suggests that Buffett is not motivated solely by maximizing returns, but rather by a lack of attractive investment opportunities. He emphasized that nobody at the table had any effective ideas for deploying the cash. This sentiment was echoed when he stated that if the market was overvalued, as he perceives it to be, a crash would be necessary for it to become undervalued again. Essentially, his hesitance to invest indicates his belief that the market is currently inflated beyond reasonable levels. Many observers interpret Warren Buffett's actions as a signal that he's anticipating a potential market downturn, although he may not explicitly acknowledge it. In 2001, Buffett introduced a key indicator, now widely recognized as the Buffett indicator, to assess the overall valuation of the U.S. equity markets. This indicator compares the U.S. GDP to the total market capitalization of publicly traded companies in the country, providing insight into the relationship between economic output and market value. Any substantial disparity between these two components is clearly reflected in the indicator's analysis. Buffett himself has described the Buffett indicator as probably the best single measure of where valuations stand at any given moment, underlying its significance in evaluating market conditions. Currently, the Buffett indicator is at 199%, indicating that the U.S. markets are considerably overvalued, surpassing historical averages by nearly 2 standard deviations. This notable deviation from the norm suggests a potential imbalance in market valuations. For instance, during periods of market exuberance, such as the dot-com bubble in the late 1990s, the Buffett indicator would have signaled elevated market valuations compared to economic fundamentals. This historical context highlights the indicator's relevance in identifying potential market distortions and signaling periods of market excess. The current reading of 199% serves as a stark reminder of the market's heightened valuation levels and the need for caution in investment decisions. Throughout history, whenever the Buffett indicator has surged to such heights, the market has invariably experienced significant downturns. This historical pattern underscores the potential seriousness of the current market situation. Unlike many in the finance world who attempt to forecast recessions, Warren Buffett and Berkshire Hathaway take a different approach. They openly acknowledge their inability to predict when economic downturns will happen. However, their track record suggests a keen awareness of market valuations. Instead of speculating on timing, they focus on recognizing when assets are overvalued. Their philosophy revolves around the belief that market forces will eventually correct these imbalances, creating opportunities for prudent investors. For instance, during the dot-com bubble of the late 1990s, Berkshire avoided tech stocks despite immense market enthusiasm. Buffett famously remarked that he didn't understand technology businesses well enough to invest in them. This caution saved Berkshire from significant losses when the bubble burst in the early 2000s, demonstrating Buffett's ability to identify overvalued sectors and exercise patience in deploying capital. Similarly, during the global financial crisis of 2008, Buffett remained cautious despite widespread optimism in the housing market. While others were heavily invested in mortgage-backed securities and risky financial instruments, Berkshire maintained its focus on fundamentally sound businesses with durable competitive advantages. When the crisis unfolded, Berkshire was well-positioned to capitalize on distressed assets, acquiring lucrative investments at bargain prices. More recently, Buffett's hesitance to deploy Berkshire's substantial cash reserves amid the current market exuberance reflects his adherence to this principle. Despite low interest rates and pressure to invest, Buffett remains disciplined, waiting for opportunities that align with his long-term investment criteria. This historical context underscores Buffett's prudent approach to investing, grounded in the recognition of market overvaluations and the patience to wait for favorable conditions. Warren grasps that although he cannot pinpoint the exact timing or location of these market corrections, the present circumstances deviate from the norm and are likely to evolve swiftly over time. In a recent discussion, he conveyed a sentiment that encapsulates this perspective. He said, "It's not as though I'm on a hunger strike or anything of that sort. It's simply that the current landscape lacks attractiveness, and there are avenues for change that we'll monitor closely." His remarks imply an anticipation of shifting conditions. Reading between the lines, it becomes evident that he perceives the stock market as significantly overvalued, a sentiment echoed by various indicators. For instance, consider the 10-to-2 Treasury yield, a reliable predictor of economic downturns over the past half-century. Currently, it's remained inverted for over 630 consecutive days, surpassing the previous record established in 1978. This inversion, where short-term bond yields exceed those of longer-term bonds, historically heralds an impending recession. Such indicators reinforce the notion that the market may be heading towards a correction. Investors often view indicators like the 10-to-2 chart as warning signals of potential economic challenges in the near future, indicating a preference for higher short-term returns due to anticipated economic struggles. Conversely, they may be optimistic about long-term prospects, leading them to accept lower returns on investments with longer horizons. The 10-to-2 chart, currently below zero and inverted, historically signifies a negative trend. Typically, a recession isn't imminent until this line returns above zero and ceases to be inverted. While there are currently no definitive signs pointing to an impending recession, the prolonged inversion of the 10-to-2 chart raises concerns. Breaking the record for the longest period of inversion suggests a potential recession may be on the horizon sooner rather than later. Investors closely monitor these indicators for shifts that could signal changes in economic conditions and adjust their investment strategies accordingly. It's essential to remain vigilant and responsive to evolving market signals to navigate potential economic challenges effectively. Numerous Berkshire investors understand that Warren Buffett avoids openly expressing negative views on the market, recognizing the difficulty in precisely timing recessions. However, savvy investors recognize subtle cues in his statements that suggest a bearish outlook. Presently, it's apparent to many that Buffett holds particularly pessimistic views. According to Bill Smead, Chief Investment Officer at Smead Capital Management, this marks the most pessimistic stance Buffett has ever taken. He asserts that being fully in charge, the discussion revolves around Berkshire's substantial cash reserves, nearing $200 billion. Regarding its utilization, he questions whether shareholders prefer dividends, acquisitions, or share buybacks. Expressing disinterest in dividends, he acknowledges the importance of aligning actions with Berkshire's ethos, emphasizing the need to follow actions over words. Perceiving Buffett's actions as indicative of significant bearishness, he notes a subtle shift during a recent meeting, observing Buffett's strategic reduction in Apple holdings, and anticipates a substantial capital deployment during a significant market downturn. Reflecting on Buffett's stance, he remarks that this represents the most bearish sentiment he's ever witnessed. In analyzing Buffett's cautious approach to deploying capital, one must question whether it signifies a bearish outlook or simply a prudent response to overvalued market conditions. To understand Buffett's current stance, it's essential to delve into his historical investment strategies and his evolving views on market valuation. Buffett's investment journey is marked by a transition from a quantitative approach to a more qualitative one. In 1969, he shifted from being primarily influenced by the quantitative principles of Ben Graham to embracing Charlie Munger's qualitative perspective. This shift reflected Buffett's realization that simply buying undervalued stocks based on quantitative metrics was no longer sufficient. Instead, he began prioritizing the acquisition of high-quality companies at reasonable prices, emphasizing intrinsic value over numerical metrics. Throughout his career, Buffett has emphasized the importance of patience and discipline in investing. He famously remarked in the late 1960s that the quantitative ideas he previously relied on were combed and recombed, indicating a scarcity of attractive investment opportunities. This sentiment resonates with his recent statements about the current market being expensive and picked over. Buffett's reluctance to deploy capital stems from his belief that the market is overpriced rather than a pessimistic view of its future prospects. Furthermore, Buffett's caution is compounded by the sheer size of Berkshire Hathaway. As the conglomerate has grown, Buffett acknowledges that finding meaningful investment opportunities has become increasingly challenging. He has consistently emphasized that the larger Berkshire gets, the more limited its options become. This limitation underscores Buffett's hesitance to rush into investments during periods of market exuberance. Examining Buffett's actions provides further insights into his current mindset. Despite Berkshire's significant cash reserves, Buffett has refrained from making large-scale acquisitions or investments. Instead, he's opted for smaller, strategic moves and stock buybacks. This selective approach aligns with Buffett's belief in waiting for opportune moments to deploy capital rather than chasing overvalued assets. Moreover, Buffett's recent trimming of his Apple holdings and his strategic moves indicate his anticipation of a significant market downturn. He recognizes the cyclical nature of markets and understands that periods of overvaluation are often followed by corrections. His actions suggest a readiness to capitalize on opportunities presented by market downturns rather than a pessimistic outlook on the market as a whole. In essence, Buffett's cautious approach to deploying capital reflects his adherence to fundamental investment principles and a pragmatic assessment of market conditions. Rather than signaling a bearish stance, it signifies a rejection of the idea that the current market presents attractive investment opportunities. By staying true to his long-term investment philosophy and patiently waiting for favorable conditions, Buffett remains committed to preserving and growing Berkshire Hathaway's wealth over time. Throughout history, economic turbulence has followed cyclical patterns, often leading to periods of recession and market corrections. Examining case studies such as Japan, Germany, and the interwar period, alongside broader historical events, provides valuable insight into the potential factors driving Buffett's actions. Marxist economic theory offers a lens through which to analyze these cycles of economic turbulence. According to Marx, capitalism inherently contains contradictions that lead to periodic crises of overproduction and underconsumption. These crises often manifest as economic recessions or depressions, characterized by failing production, rising unemployment, and declining asset prices. In Japan, for example, the bursting of the asset price bubble in the late 1980s led to a prolonged period of economic stagnation known as the Lost Decade. Excessive speculation in real estate and stocks drove asset prices to unsustainable levels, eventually resulting in a sharp correction and prolonged economic malaise. The Japanese government's response, characterized by loose monetary policy and fiscal stimulus, failed to spur robust economic growth, highlighting the challenges of navigating post-bubble economies. Similarly, Germany experienced economic turmoil during the Weimar Republic period between World War I and World War II. Hyperinflation, fueled by the government's attempts to finance wartime expenditures, decimated the value of the German mark and eroded confidence in the country's economic stability. The resulting social unrest and political instability contributed to the rise of extremist political movements and ultimately culminated in the devastation of World War II. Examining broader historical trends such as the Great Depression of the 1930s provides further evidence of the cyclical nature of economic crises. The collapse of stock prices in 1929 precipitated a global economic downturn characterized by widespread unemployment, bank failures, and deflation. It took years of government intervention and stimulus measures, including Franklin D. Roosevelt's New Deal programs, to restore economic stability and confidence in financial markets. Moreover, ancient civilizations also experienced periods of economic turmoil and crisis. The oil crisis of the 1970s serves as a modern example of how external shocks can disrupt global economies. The Organization of the Petroleum Exporting Countries imposed an oil embargo in response to Western support for Israel during the Yom Kippur War, leading to a quadrupling of oil prices and stagflation in many Western countries. The resulting economic downturn highlighted the vulnerability of industrialized nations to external supply shocks and underscored the importance of energy security and diversification. In light of these historical precedents and economic theories, Warren Buffett's cautious approach to deploying Berkshire Hathaway's cash reserves appears prudent. The accumulation of a massive cash pile may indicate a belief that current market conditions are overvalued and vulnerable to correction. By maintaining liquidity and flexibility, Buffett can capitalize on opportunities that arise during periods of market distress, such as economic recessions or downturns. However, it's essential to acknowledge that predicting the timing and severity of economic downturns is inherently challenging. While indicators like the Buffett indicator and the 10-to-2 yield curve may provide insights into market valuations and potential risks, they're not infallible predictors of future economic conditions. Buffett's actions or inaction should be viewed within the broader context of his long-term investment philosophy and strategic approach to wealth preservation and growth. So, by examining historical case studies, economic theories, and broader historical trends, we gain valuable perspectives on the potential factors driving Warren Buffett's cautious approach to deploying Berkshire Hathaway's cash reserves. While the exact timing and severity of economic downturns remain uncertain, Buffett's adherence to fundamental investment principles and readiness to capitalize on opportunities during periods of market distress position Berkshire Hathaway for long-term success and resilience in an uncertain economic environment. As Warren Buffett issues a truly bizarre warning, cautioning against overvaluation and potential for market correction, the implications extend far beyond Berkshire Hathaway's investments. In Europe, where economic recovery remains fragile amidst geopolitical tensions and structural challenges, Buffett's warning serves as a sobering reminder of the risks inherent in global financial markets. The continent, already grappling with the aftermath of Brexit, the sovereign debt crisis, and sluggish growth, could face heightened volatility and uncertainty in the event of a significant market downturn. Moreover, in an interconnected world where economic shocks can quickly reverberate across borders, Buffett's cautionary stance has implications for the global economy as a whole. Financial markets, already jittery amid concerns over inflation, central bank policies, and geopolitical instability, could face renewed turbulence if Buffett's fears materialize. This could dampen investor sentiment, disrupt supply chains, and weigh on consumer confidence, potentially undermining the fragile recovery underway in many parts of the world. Furthermore, Buffett's warning underscores the importance of sound risk management and prudent financial decision-making in an increasingly complex and uncertain environment. As investors navigate choppy waters, Buffett's long-term perspective and emphasis on fundamentals serves as a valuable guide, reminding us of the importance of patience, discipline, and resilience in the face of market volatility. Thank you guys for watching, as always. Please make sure you hit that like and subscribe buttons if you enjoyed, and let me know what you think will happen in the markets in the comments below.